What's up everyone, it's Brandon. Did you know that you can use a health savings account as a tax-free investment account? The health savings account rules provide investment options that almost no one seems to be discussing. In most cases, people use their HSAs to save for medical expenses such as annual checkups or unexpected visits to the emergency room. However, many HSA providers also allow account holders to invest a portion of their contributions for advanced savings. In my opinion, the health savings account is the ultimate retirement account. This video will explain how to maximize your savings potential when using an HSA and why you should invest your contributions instead of using them for medical expenses. In addition, I'll give you an inside look into an HSA I created for myself using these principles. If you find this information helpful, please subscribe to this channel and ring the notification bell to be notified of future uploads. It helps my channel more than you know, and I genuinely appreciate the support. Now let's get started. Okay, so what makes the HSA so special? Well, let's start by asking the most basic question: what is a health savings account? A health savings account, or an HSA, is a savings account that allows you to set aside pre-tax money that you can use for qualified medical expenses. Using an HSA will decrease your taxable income and lower your general healthcare costs. HSAs will cover almost any medical cost, including dental and vision. Unfortunately, it's not possible to use an HSA to pay for insurance premiums or over-the-counter items such as toothpaste. You can use the funds from an HSA to pay for qualified medical expenses at any time. However, to qualify for an HSA, you must enroll with a high deductible healthcare plan. A high deductible health plan, or an HDHP, is an insurance plan with higher average deductibles than traditional healthcare plans. In general, HDHPs have lower monthly insurance premiums, which result in a savings advantage for people who rarely use their healthcare benefits. One disadvantage is that people end up paying more out of pocket for healthcare before their insurance provider covers its share. According to the IRS, a high deductible health plan is any healthcare plan that has a deductible higher than $1,400 for individuals or $2,800 for families. In addition, the maximum out-of-pocket expenses, including deductibles, co-payments, and other amounts, cannot exceed more than $7,050 for individuals or $14,100 for families. It's not possible to use an HDHP in conjunction with other healthcare plans. For this reason, be sure to review your options before choosing a high deductible health plan for coverage. Now let's talk about who's eligible to open an HSA. Your employer might offer a high deductible health plan with an HSA option, or you can open an account with a participating bank or financial institution. According to federal guidelines, you may open an HSA and contribute if you meet the following conditions. You are covered under a high deductible health plan, which meets the qualifications for minimum deductible and maximum out-of-pocket expenses. You are not currently enrolled in any other medical plans, including Veterans Medical Benefits. You're not enrolled in Medicare, TRICARE, or TRICARE for Life. You do not have other medical savings accounts such as a flexible spending account, and you are not eligible for an HSA if you can be claimed as a dependent by any other taxpayer. The IRS updates the contribution limits for health savings accounts annually. Be sure to read and understand the health savings account rules regarding contribution limits each year. The following table shows the maximum contribution amounts for both 2021 and 2022. As you can see, for individuals, you can contribute up to $3,650, and for families, you can contribute up to $7,300. Additionally, if you're 50 years or older, you can contribute an additional $1,000 every year. When can you withdraw money from your HSA? With an HSA, you can withdraw funds at any time when used for qualifying medical expenses. The money in a health savings account is yours and works similarly to a traditional savings account. A significant difference is how much you can put into your account and use the funds to purchase. Using money in your HSA for non-qualifying expenses will result in a 20% penalty in addition to income taxes, which for obvious reasons you should always try to avoid. Once an account holder reaches age 65, they can make withdrawals tax-free for qualified medical expenses and non-qualifying purchases. Saving for retirement is one of the best reasons to use an HSA. According to health savings account rules, HSAs can be used to purchase anything once you reach age 65. However, since contributions are made tax-free, money withdrawn after age 65 is considered taxable income for non-qualifying purchases. As a result, you can lower your taxable income now and use your health savings account as a pre-tax retirement account later. How do you use your HSA to pay for medical expenses? Many health savings account providers offer debit cards that account holders can use to pay for the qualified medical expenses. It's possible to write a good old-fashioned check when making payments, but this depends on the bank that you use for your HSA. Payments made using a health savings account will count towards the deductible. Another standard method is to use an online payment service such as Fidelity Bill Pay to pay for the qualified medical expenses electronically. This service allows you to make a one-time payment or set up recurring payments for your convenience. Alternatively, you have the option to pay for the qualified medical expense out of pocket and then just reimburse yourself later at any time. If you choose this option, and as long as you open the HSA before incurring the cost, the reimbursement amount will be tax-free, as are regular contributions. When paying out of pocket using an HSA, it's essential to save your receipts for all qualified medical expenses. Save your receipts for eligible medical costs because they never expire and they can be used to your advantage. By leaving your cash in the HSA instead of withdrawing for medical expenses, you'll have more funds to reinvest for extra savings. For example, you might want to pay for qualified medical expenses out of pocket now, grow the invested cash in the meantime, and then reimburse yourself during retirement. One feature that makes this account shine is the potential for employer contribution matching. Many employers, including school districts, will match employee contributions up to a predetermined amount each year. For example, employers might match 100% of the amount up to $1,825. As an individual, this would mean that you only need to contribute an additional $1,825 to reach the annual contribution limit of $3,650 each year. These match contributions are money that you can invest for free if you decide not to use them for qualified medical expenses. Another good reason for using an HSA is to invest for retirement savings. Contributions made to an HSA are made on a pre-tax basis, similar to a 401k or a traditional IRA, and treated the same way when filing taxes. However, one distinction is that the IRA contribution limits are higher than a health savings account. Although the contribution limits are not as high as a traditional retirement account, HSAs have an advantage of being able to use your money for qualified medical expenses at any time, tax-free, and without penalty. Unlike traditional retirement accounts, contributions made to an HSA have an incredible triple tax advantage. Simply put, HSA contributions go into the account tax-free, they grow tax-free, and are withdrawn tax-free for qualified medical expenses. Okay, so you know about the triple tax advantage, but what about actually using the HSA during retirement? The reason the HSA is the ultimate retirement account is that you can make withdrawals for anything after age 65, including non-qualifying purchases. You can use an HSA just like you would a 401k, including investments, but with the addition of medical savings benefits. This is a new HSA account that I started about a year and a half ago. Most banks give you options to grow your account by investing a portion of your HSA funds. Investment options are usually available once your account reaches a specific threshold. For example, the balance threshold for HSA Investing with Optum Bank is $2,100. Optum Bank lets you invest a minimum of $100 as long as $2,000 always remains in the savings portion of the account. In most cases, you design an HSA investing portfolio by selecting from a list of predetermined mutual funds. As an example, Optum Bank offers dozens of mutual funds such as Vanguard 500 Index Fund and Schwab Target 2040 Index Funds, to name just a couple. In addition, there are usually multiple asset classes to choose from to help you create a well-diversified and balanced portfolio. On this screen, you can see how much money I have contributed into my health savings account. My total HSA balance is $3,858, and the savings part is currently sitting at $2,152. So because I've met the minimum threshold, I've transferred over about $1,700 into the investment portion of the portfolio, where I have pre-selected mutual funds with Charles Schwab. And if you look on the right side of the screen, you can see which funds I've selected and where the investment portion or the investment side of my money actually sits at the moment. Well, that's it for this video. Don't forget to like and subscribe to this channel for more dividend growth investing and personal finance videos. Thanks again for watching, and I'll see you next time.